Good morning, everyone. Just a reminder, my name is Neel Kashkari, President of the Minneapolis Fed. I'm excited to be here with you today. Also excited to have our wonderful policy panel here today to talk about some of the policy implications of the ideas that we've been talking about. I'm going to very briefly give an introduction. Each of our distinguished panelists will have about 10 minutes to go through some prepared perspectives that they have, which we appreciate that they did some preparation for this. Then I'm going to lead them in a discussion. Rather, I'm going to be asking them questions, and then we're going to open it up to all of you to ask your questions as well. So please think about questions to ask them. Very quickly, I know our panelists don't need any introduction, but for the folks watching at home, seated to my right is Douglas Diamond, the Merton M. Miller Distinguished Service Professor of Finance at the University of Chicago Booth School and the 2022 Nobel Prize winner. Seated next to Doug is Andrea Eisfeldt, the Laurence D. and Laurie W. Fink Endowed Chair in Finance and Professor of Finance at UCLA Anderson School of Business. And my claim to fame is that Andrea and I went to college together, though we didn't know each other, but we were both at the University of Illinois at the same time. And then I was in engineering school. We had different social circles, let me just say that. I think that's fair. And then last but not least, Hyun Song Shin, Economic Advisor and Head of Research for the Bank for International Settlements. So first of all, join me in welcoming our panelists. Let's start with Doug, and Mike is yours.
Great, thanks very much, Neel. Get this thing turned on. Thanks very much, Neel. I'm going to talk today about what we sort of learned about bringing back the savings and loan crisis to bite a second time. And a lot of people have talked about how this was maybe a failure of bank supervision. But if you think about it, it was actually, to some extent, an unintended consequence, like most of regulation, and how incentives set up over time sort of gave the regional banks an incentive to cause real trouble. So we saw interest rate increases, nominal interest rate increases, because the Fed had to deal with inflation above target. And we then saw we saw runs and a lot of reduced net worth of a bunch of banks, particularly the regional banks, particularly the ones in California. So just starting with sort of how we got into this, the liquidity rules that came in after Dodd-Frank, liquidity coverage ratio in particular, gave banks in general and the very big banks, but also the big regional banks, an incentive to hold more liquid assets and treasury securities, but also things that were reasonably liquid, like U.S. government agencies. Okay, so that was the first thing. So there was a little bit of movement toward traded securities because they loosened the liquidity issues. We also had we had QE, which flattened the yield curve, but didn't make it totally flat. So we saw both First Republic and Silicon Valley taking lots and lots of interest rate risk to pick up a spread of 60 to 75 basis points. So again, you think about QE. QE probably as much lowers the term premium as it does lower expected future spot rates. But I got the feeling, if you listen to the head of Silicon Valley, he basically said, look, the Fed promised not to raise any interest rates on us. It's not exactly what he said, but his idea was that expected future spot rates were likely to be pretty flat. So maybe there was a misinterpretation or a form of maybe excess credibility in monetary policy. So how could that go wrong? Well, one thing is that the liquidity rules counted liquid assets for the liquidity coverage ratio for long-term treasuries, for long-term agencies. And the interesting thing is, we also had this hold-to-maturity accounting that meant that these things were not marked to market. So I'm going to argue that provided an ex-ante incentive to do essentially what the regional banks in California did, is put these longer-term agency securities on the books they didn't have much of a ex-ante capital ratio, but then because you didn't have to mark them to market, you didn't really have to think about raising capital against them in the future if you had losses. So from a sense of a capital, I'll talk about capital requirements in a second, but as long as you satisfy your capital requirement when you buy them, unless like the FHA defaults or something like that, you really don't have to worry about future capital requirements. The last thing, and this is sort of a little bit of what was going on in First Republic, they were not holding agency securities, they were holding mortgages. There was a fairly, the rule was, if you had a big uninsured checking account, a demand deposit, you could count it as a core deposit, which essentially wasn't runnable if you also had a loan to that customer. So I think one of the reasons that we saw that a lot of these banks were making big jumbo mortgages, it wasn't just to bring in wealth management business, it was also because that was another way to meet their liquidity coverage ratio, because once you made a loan to these people, they would never pull their money out, even if interest rates went to 90% and you were paying 0. Okay, so the point is that basically market prices and supervision are the key if you're going to put these ex-ante incentives in, you've got to have some ex-post effects of losses on the balance sheet if interest rates go up. So we brought back the savings and loan crisis. Savings and loan crisis was caused by interest rate risk. They were only paper losses, but if they're only paper losses and your net worth is like minus 20%, the fact that they're only paper losses is not very relevant. So capital regulations, the initial capital regulation is only an issue, only will be enough essentially if you get close to 100% capital. So yeah, we started at 90% capital, but we're never going to make you raise any more. When you get it down to 2, 3, minus 5, minus 10, it won't provide incentives. So that's one reason, if you're going to encourage people to hold assets that are liquid and have market prices, you've got to use those market prices. So if you have some assets that you don't have to mark to market, these hold-to-maturity securities, and other ones that you do, again, you're going to be biased again from capital requirements, future capital requirements toward holding these. So we saw interest rate risk as a problem. We saw it in the savings and loan crisis, but we brought it back. And I'm going to argue that the Federal Deposit Insurance Improvement Act, the 1991 post-S&L crisis law, essentially did pretty well, but it's a little ironic. We'll see how it worked, how it dealt with interest rate risk. Okay, so this is just the Silicon. This is from the board's report on their wonderful supervision of Silicon Valley. So we saw in the fourth quarter or the third quarter of 2022, they had unrealized losses even in their held-to-maturity book, not the available for sale, which also didn't have to mark to market. They had losses in excess of their capital. So they actually had negative capital. There's a question, maybe they could continue to borrow cheap. But this is the problem. We had an institution that was still in business, and it was essentially insolvent. So the reason you wouldn't mark everything to market is maybe you have illiquid assets where you don't have a good market price. But it doesn't really make any sense for liquid securities. And once people know that an institution is insolvent, there's obviously going to be a run. That's not a panic. That's just saving some, getting your money out before it runs out. But even if people would think under normal circumstances you'd leave your money in the bank and just because you're not paying attention or there's no point, it's not worth moving it out. If you're like Circle and you had like $1 billion in the bank, it doesn't apply to them. But for most people, they're going to say they're not going to bother. But if you think the bank's assets are worth less than liabilities, then even if the assets are totally liquid, you could still have a panic run. Just Thomas and Amit and et cetera have a paper along these lines. Okay, so the Federal Deposit Insurance Improvement Act was like the best banking regulation we passed in a long time. Basically, what it did is have dynamic capital requirements. Now, they were book. They were not marking anything to market, but they were book. And Gary Stern was pushing these things. I mean, the Minneapolis Bank has a lot to do with this. So regulatory intervention at higher levels of book capital than insolvency. You limit dividends, you can limit interest payments on deposits. Eventually you get prompt corrective action. If you don't, you get, that's a threat. If you don't get that, they close you down. So it worked pretty well. And if we look at it in 1991, this is the savings loan crisis. In 1991, after this, there really weren't any bank failures for a good long time. And I used to teach that basically you don't need fancy stuff in bank regulation. All you got to do is make sure you wipe out the equity holders and limit their dividends and things like that if they become insolvent. You can have insured deposits and things like that because the depositors aren't going to monitor anyway. So then we saw the great financial crisis. This is as fractions of GDP, but the stuff in 2023 was almost as big. Okay? So it worked pretty well. But the thing is, it was about interest rate risk, but there's no market value stuff being used there. And if we looked at interest rates, we're pretty much going down monotonically until 2021, 2020, till 2022, in the period after the Federal Deposit Insurance Improvement Act. So it's a little ironic to have something where interest rate risk was the cause, but interest rate risk is not measured in the way you use capital requirements. So mark-to-market, essentially, on interest rate risk is, I think, an essential, if you encourage banks to hold liquid securities, not using their prices is totally lunacy. So market prices are good for bank incentives. I think they're good for incentives for supervisors and regulators. Supervisors and regulators sort of don't like markets, right? Like they're like the other team against who they really don't believe in. But if you just think about it, incentives for supervisors and regulators, we need mark-to-market. And if you don't do it, capital requirements, unless you set 100% or close to it, pretty much don't do anything. Thank you very much.
Okay, can you hear me? Great. So this is a very illustrious panel. I'm very happy to be back here at Minneapolis where I have to put my lab coat on. So I'm going to discipline my comments by talking about some current research that I have on the deposit business at large versus small banks. So we want to think about this fact in the context of customer preferences and bank technologies. So we really want to take this discussion of how deposit market competition takes place back to basics. We're going to have a model that generates a size distribution, product market competition, but we're not going to have any kind of strategic behavior. It's going to be a model of entry costs and competition. We're going to argue that large banks offer a different product with superior liquidity services. Consumers have a willingness to pay for this, so they can offer lower deposit rates. Large banks, though, have uniform rates, and so they're going to want to operate in areas that have consumers that have similar preferences. Most elasticities in the US, it turns out, are very low. So depositors in the US tend to have low deposit rate elasticities, but there's a fat right tail with high deposit elasticities, and that right tail is served by small banks. We want to stand in stark contrast with a literature that recently in banking has really focused a lot on HHI and local market concentration as a way of thinking about deposit market competition. We're going to kind of go back to a very classic idea in IO, that is that prices are not the only dimension along which competition takes place. Prices are something you pay for differentiated products, and deposits are differentiated products. So we saw a graph just like this yesterday. Large banks have over 50% of deposits, and this is true if you look at sort of 4 banks, or we're going to look at the SCAP banks, essentially Dodd-Frank banks that are depositories. That's 14 banks, or you can take the top 1% of banks. But it's really key to understand the difference between large banks and small banks when you think about deposit market business and deposit market franchise, because when you run regressions and weight observations equally, you're getting tons of small banks, and you're overweighting them relative to their importance in the deposit market. So I want to establish 3 facts. Not all of these are new. The first one, large banks set uniform rates. This is a fact that even in banking goes back to the 50s or 60s with papers by people like Loretta Mester. But we kind of forgot it along the way, and people have reestablished this fact. Large banks set uniform rates. We see this in other markets too, like supermarkets. Large banks also set lower deposit rates, and they serve urban, younger, higher income and house price depositors. So think to yourself, do you bank at a small bank or large bank? And I'm not going to ask you to respond, but I would guess that a majority of you bank at a large bank and think of yourselves as financially sophisticated consumers that normally would not be getting a lower return on your financial investments. So let me establish those facts. Uniform rates. I'm going to do something very simple. I'm just going to regress bank deposit rates at the branch level in weekly data on bank times time fixed effects. And I'm going to tell you that that explains between 90 and 95 and even higher fractions of the variation. So most of the bank variation is just explained by bank times time fixed effects. And then the residual is not explained by things like HHI or population or anything about local market characteristics, though we do have some success in explaining that variation with our estimated elasticities. So large banks pay uniform rates. Second fact is that small banks offer higher deposit rates, small bank rates in black, large bank rates in blue, and you can see that the small bank rates are about 30 basis points on average higher than the large bank rates. So small banks paying a higher rate. The third fact is about the different demographies and geographies of large banks. So this is a map of population in green. Darker green is higher population, and red is the location of large banks. You see the large banks are located in the urban centers that have younger, richer, higher house price consumers. These large banks are paying those consumers lower deposit rate. This flies in the face of things like these types of consumers prepaying their mortgages more optimally, and also might seem to fly in the face of them investing more optimally in terms of stock market participation and a broader array of bond market. But when you think about it, it shouldn't be puzzling. These consumers are participating in other financial markets, so they're able to treat their deposits kind of like a barbell strategy. It's not a yield-generating asset. It's serving a true liquidity function. And that's different from other parts of the country and other types of consumers where deposits might actually be thought of as a yield-generating asset for depositors that don't participate in other financial markets. So I'll show you a second map. This is the map of rates with higher deposit rates being denoted in green. You can see it's exactly the flip side of where the large banks are located. Large banks are on the coast where the low rates are. Small banks are in the middle where the high rates are. And I want you to keep in mind also that the middle of the US is also where population density is lower, and HHI tends to be very negatively correlated with population density. Where you have rural areas, you also tend to have high HHI because there are few institutions serving these consumers. Another interesting fact, this is deposit rates of small banks as a function of the market share of large banks. You see a clear declining pattern where small banks actually pay lower rates where they co-locate with large banks. So these small banks, when they co-locate with large banks, are not being forced to offer higher rates in order to compete. Those small banks are facing the same demographics, the same demand curves as the large banks. And so as a result, when they locate where large banks are, they're actually offering the lower rates that are consistent with the preferences of the consumers in those locations. So we're going to have a simple one-shot model, but it is able to match all of these key stylized facts we think that can help us understand the deposit business at large versus small banks. We're going to start with K markets, so you can think of it as kind of an island economy. These markets have different elasticities and differences in willingness to pay for liquidity services. Importantly, providing liquidity services is going to require banks to pay a fixed cost. It's also going to there's also going to be a fixed cost for opening a branch in one of these K markets. If banks operate across markets, they're going to have to offer uniform rates. So we're going to impose that assumption. That's going to lead to a very key trade-off. The small banks are going to be able to price to the market. The large banks are going to have to offer uniform rates, but they can defray the fixed costs of offering superior liquidity services by operating across many markets. So you have these banks choosing technologies based on the markets that they're going to operate in, and large and small banks will operate in different markets. Large banks in particular are going to, because they have to offer uniform rates, they're going to look out at the markets, and they're going to look for markets that are similar in terms of their demand elasticities. They're going to want to locate in sort of the predominant elasticity markets, and then they're going to compete with their liquidity services. So the last thing I want to talk about is how we estimate the demand elasticities, and we're going to use a BLP type of estimation. We're going to start with preferences that essentially match the preferences that we've given our consumers in the model. So consumers are going to choose their allocation to cash, bonds, and deposits of a certain bank J in order to maximize their utility. They're not going to like when spreads are higher, so it's spread under Fed funds rate, so there's a sensitivity to that spread of minus alpha. They're going to like certain bank characteristics, which will include liquidity services, that's captured in X, and then we're going to have these random taste shocks. The rate sensitivity is going to be allowed to depend on income, and then these shocks are going to follow an extreme value distribution, and that's so we can get closed form solutions for things like market share in the standard way. We're going to use supply shocks as instruments, as is common in this literature, so those costs are going to have relevance because they influence pricing and satisfy the exclusion restriction because we're going to argue demand is insensitive to these costs changing. Let me show you what we find. So on the left, you have the full sample of demand semi-elasticities. On the left of that x-axis is 0, that's a density. So you can see that the majority of elasticities in the US are kind of centered around a pretty low number. In the US, depositors tend to be fairly inelastic with respect to deposit rates. On the right, I'm showing you the elasticities in markets served by large banks and by small banks. Now, in our model, small banks operate everywhere, and large banks only choose to operate in those sort of predominant elasticity areas. That's kind of what you see here. The large banks are operating in the markets and face the elasticities that are centered around the kind of predominant low elasticities of the majority of consumers. And then small banks are operating everywhere, including in the rate-sensitive areas, and they are, as a result, offering higher rates while the large banks are offering lower rates. We relate these elasticities to demographics. Rich households are less sensitive to rates, care more about financial services. So I'm going to conclude here and just say that I think it's really important to take a step back and start with some kind of very simple ideas that don't rely on HHI or strategic pricing and kind of just classic ideas of banks choosing technologies based on the consumer preferences and the places they operate to understand the difference between large and small bank deposit businesses. Thanks.
Well, thank you very much, Neel, and thank you to the organizers for the very kind invitation. It's great to be here, actually, and reconnect with old friends. I do have a couple of slides, but I'm not going to dwell too much on the slides themselves, although I will start with this one, just to give you more of a background. What I want to do is to broaden out the discussion. So we've focused very much on the banking sector. What I want to do is to broaden out that discussion and I think put some of the things that we've discussed in broader context. So what I'm going to do is to show you this chart. What it shows is the way that various sectors have grown. I'm using the flow funds, and I'm looking at three sectors here: households, non-financial corporates, and the broker-dealers. And I've normalized all these charts so that all these series so that they start off at 100 in 1990. And what you see is both households and non-financial corporates have grown. So this is just the total asset size, the total size of the assets of the sector as a whole. But what you really see very dramatically is the growth and then the subsequent pullback of the broker-dealer sector. And there is a story behind this, of course, because there's the story up to the GFC, and then the pullback thereafter. If you look at the leverage of the broker-dealer sector itself, I mean, that's also quite dramatic. And the leverage series follows very closely the trajectory of the assets because most of the changes in the assets are coming from debt. And so, the equity is growing, of course, but a lot of the cyclical fluctuations are coming from debt. As a rule of thumb, the broker-dealer sector had a leverage of 50 just before the GFC, and that's now fallen right back. So what is the story that underlies at least the first part, and then up to the deleveraging, right up to the, in the early stages of the resolution of the GFC? Well, clearly, a lot of the businesses that the broker-dealers were doing are not being done. So, for example, the subprime securitizations, they've now gone. And Neel, you were very close to this in your previous public office. There's also been some other changes behind this that I think is well worth bearing in mind. So the money market funds have seen dramatic changes over this period as well. So before the GFC, money market funds, the prime money market funds, were primarily a funding vehicle for banks. And not only US banks, actually it was predominantly foreign banks that were using the money market fund, the prime money market funds, as a funding vehicle to secure dollars. As a rule of thumb, just before the GFC, 50% of the assets of prime money market funds were the obligations of European banks. That's a kind of rough rule of thumb. 80% the obligations of foreign banks. But since the GFC, we had, of course, the money market fund reform. Now it's the government money market funds that have really taken center stage. So these are now a very, very important part of the financial landscape. And they're providing short-term funding to people who pledge government securities as collateral. So this is the repo market in particular. And again, it's not just US institutions, but this is very much a global story. And we'll hear something about this from Hyun Shin in the next session as well. And so who are the people who are pledging the government securities? Well, think about this as a way of funding leverage to hold treasuries. So, of course, actually some banks do this. They actually do some of this repo borrowing to have a leverage position in government securities. But of course, there are many, many non-regulated institutions in this sector. And we saw, for example, during the March 2020 episode, how important the relative value hedge funds were for this space. Why do we care about that? Well, I think one type of reasoning would be, well, we shouldn't really care about market sort of ups and downs as such, but of course, if it actually has a bearing on the real economy, that's when we should be worried. So when the yield curve steepens, when financial conditions tighten, that's going to have a huge implications for monetary policy, as well as for financial stability. Another element, and I'll just finish with this before sort of moving to the bigger picture. Neel, we've been following what you've been saying about private credit firms. We saw your remarks in Buenos Aires recently. They're a very important new set of actors in the financial system, especially private credit, because these are mainly equity-financed entities. So rather than banks who are very highly leveraged, these are pretty much, mostly equity-financed. So if you calculated the capital ratio, they would be close to 100%. Well, actually, it's not even risk-weighted, so it's probably 100% capital funded, even on an unweighted basis. And they've grown to be quite a big chunk of the market. So globally, they're around $2 trillion worth. The US part is about 2/3 of that. But compared to the commercial bank sector, this is still small. So commercial bank total assets, $23, $24 trillion. So 1.4, 1.5, that's really still a very small part. Could they take on more of the lending? Well, let's see. I think they've been growing very fast. But I think this is where I'd like to just change the story a little bit. Although actually, maybe we can come to this in our general discussion. The fact that private credit is funded by equity, pretty much, I think does say that the cost of equity probably is not the reason why banks can't do the same thing with their equity financing. There must be something else. And maybe we can explore what that something else might be, why they're so against capital. But what I did want to do is to say, well, what else are we missing if we're just focusing on credit? Because banks do a lot more than simply provide credit. And Andrea has just shown us the importance of liquidity services. But I think we need to bear the structure of the financial market more in mind when we think about the bigger issues, both in monetary policy as well as in financial stability. So the fact that now reserves, so the claims that commercial banks have on the central bank, the fact that reserves now have a very, very important part in the business model of large banks, I think should give us some additional reasons to focus on this. And Wen-Shin's going to talk about this in the next session. What's happened is, in the era of large central bank balance sheets, commercial bank business models have changed fundamentally from the way that they were before the crisis. With very large reserves, this is a pool of funding that commercial banks can deploy for their global business, in particular dollar lending in the wholesale funding market. And here, we have not just repos, but crucially, FX swaps. And with FX swaps, we probably underestimate how important FX swaps are. FX swaps, contractually, is completely symmetric. So I provide dollars to you, you provide yen to me, and we enter a contract that says, well, let's reverse this transaction at a fixed point in the future at a pre-agreed exchange rate. That's what an FX swap is. So once you've exchanged that spot leg, you owe the full principal. So there is a huge obligation. How large is that obligation? The BIS collects data on this. It's in excess of $100 trillion. So that's the amount of outstanding FX swaps. It's off our radar most of the time because, again, as Doug reminded us, accounting is very, very important in banking. FX swaps are not on the balance sheet. So even if you owe millions, it's not on your balance sheet. It's off the balance sheet. And we can go into the accounting later, but the accounting treatment makes a huge difference. What that means is if you're trying to meet your Basel III leverage ratio and your supervisor allows you to measure leverage at the end of the quarter rather than throughout the quarter, then what you can do is during the quarter use repo financing, but at the end of the quarter you can switch into FX swaps and then meet your leverage ratio. And there's been some very interesting work by Angelo Ronaldo, who is now one of our neighbors, actually. He's at Basel University, which shows that that's exactly why these FX swap bases are spiking. And again, this wouldn't matter that much for central banks unless it really had a huge impact on the real economy. And I think we have to think about the various channels through which we can see these unwinding having an effect on the real economy. And let me just conclude with this this quote, actually. So this is the opening quote from my Clarendon lectures. And this is a genuine quote. I went to a conference in the spring of 2007, and this is what a risk manager said at that conference. The value added of a good risk management system is that you can take more risks. And Neel, I think you can appreciate it from a market's perspective. This is the way that many institutions are guided. What this means is risk management is not about taking less risk. It's really about taking risks with a strategy to mitigate your loss when something bad happens. Now, the problem is that mitigating strategy will cause spillover effects. So if you're lending, if you're providing wholesale funding, then if your risk constraints kicks in, you say, well, maybe I should just take some risk off the table. And what that means is I cut my lines or reduce my exposure. If I am holding risky assets, why don't I sell some in order to mitigate some of the potential losses? If this is in the context of broader wholesale funding, and we haven't really talked about Credit Suisse as much as the US bank cases from last year. In the case of Credit Suisse, it's very much the wholesale funding side, which was really kicking in. And in that sense, because of the various amplification channels, it's all about the amplification channels. What are they? That I think we should take a broader perspective on some of this. So let me stop there, and we can maybe explore some of these other issues.
It's great.
Yep.
I mean, you all have given, first of all, thank you. Where should I begin? I mean, there's so much rich content that you all have already provided. Let me start, though, with something you mentioned, which is the private credit topic. So comments that I made earlier in the week were, so Doug, you and I have somewhat of a different view on bank capital, which we'll leave it for a moment. But even if you wanted more bank capital, there's not much political appetite in the U.S. to do it, as we've learned in recent months. And so I've looked at the growth of private credit, and I've said, well, is this scary? Is this an alarming development? But just as you said, if you look at how they're funded, they're generally funded with very low leverage, maybe 1 times, maybe 0, and they've got long-term funding as opposed to overnight funding. So just at a very high level, if a loan was going to be made at a commercial bank, which is levered 10 to 1 and funded overnight, and instead is made by a private equity firm with long-term liquidity and no leverage or very low leverage, that would seem to represent a de-risking of the financial system. So that's great. Let's do more of that. The only pushback that I've heard to that argument is that most of these loans to date are not loans being made to some industrial company, either by a commercial bank or by a private equity firm. It's loans from one private equity firm to fund another private equity firm's buyout. And all it's allowing them to do is buy these companies at higher leverage levels. So it may not represent a systemic risk in the financial system, but it may increase risk in the U.S. economy or the global economy to some type of economic shock. So I'm just curious, this is not exactly the topic of any of your 3 presentations, but how do you think about this? You started, you want to take it first and then we'll pass it down to the others?
Yeah, I think there was a very good chapter in the IMF's Global Financial Stability report last year, actually, on this. Actually, earlier this year, it was April when they had this chapter. The borrowers tend to be mid-sized firms rather than the large firms. But as you say, there is a lot of, if you look at the uses, it tends to be very much on the acquisition side or other longer-term projects. It's not the kind of the short-term liquidity services that a lot of banks provide. So on working capital, on many of the, on the money market side. The fact that it's still small probably means that we haven't really sort of tested the full limits of this. I think, we have to see, the full impact will need to be sort of seen in due course. But there are a couple of things that do give us pause for thought. And that is that if you look at the secondary market prices on some of these claims, they can actually fluctuate quite a lot. And given the importance of marking to market that Doug has actually reminded us of, there's always a kind of doubt whether the marked values are actually the true values. They do fluctuate. Secondary market values do fluctuate. I guess the other issue is if we do have this division, the separation between lending and other banking services, in particular banks as the main pillar of the monetary system, they're actually the primary means that we send payments back and forth that's a circulatory system for the economy. They cannot play that role. And in fact, there was the Chicago plan during the interwar years where there was a school of thought that said, well, banks should be doing the lending from a pure equity position.
Narrow banks.
The narrow bank. And then the payment side should be done by narrow banks, where you can do the payments back and forth, but then you have to hold only safe and liquid securities. And I think what we found is that model, well, I mean, there are lots of questions with that model, but I think we have to pause here and just realize that if we push this to the limit, that is the model that we're actually pushing towards.
Andrea or Doug?
Sure. So I guess I'll put my discussion of private credit more in the context of private funding rather than just banking. So I was recently in an environment where an expert on private markets said that if you took a Venn diagram of private equity and private credit, both in terms of the companies that are getting funding and the institutions that are providing the funding, it would be a Venn diagram that would almost perfectly overlap. So to me, as a researcher, one of the things that has been puzzling is the private equity market is, it's doing okay, but it's not booming like the private credit market is. And so if these markets are essentially overlapping, why are there different dynamics in these two markets? That makes me kind of confused, and I think that would be something interesting to understand. And then from the same perspective, if you have the same institutions providing private credit as are providing private equity, there's no diversification in terms of their investments, and they're holding a very risky claim on the same thing that they're kind of holding the asset, which you can say, well, there's less leverage than just holding the debt alone, but there's more leverage too.
So my comments are actually similar to the two previous ones. It's like a slightly different take on it. It's not just that a lot of the private credit is about exit from buyouts. It's private credit to the same firms who have covenants and monitoring essentially from private equity firms. So if you think about, banks do less and less of sort of the monitored type lending, but to the extent that that's still a key service, and a lot of it has migrated over to this other area, it's sort of like I'm already have enough control over management to deal with incentives in the private equity set of contracts. So those contracts, sort of the debt claims on those firms are already pre-monitored and pre-corporate governanced. So if you think about the selection of the sets of things that get into private credit, and thinking that the Venn diagram would be evidence in favor of this, that this is a particular type of credit which has already migrated over to its governance coming from private equity. So it's not clear that sort of smaller commercial industrial loans and things like that, which particularly the smaller commercial banks are still a big part of, would be able to make the same type of substitution. So it could be that the facts are true, but you can't generalize.
Yeah, but that doesn't sound scary to me. That sounds comforting.
So, but basically, there's two ways you can say it. Since these guys are already doing the private equity, private credit is a good way to fund the rest of their capital structure. And it is, usually it's not always the case that it's a different private equity firm's private credit that does it, but it could be in-house. Yeah. But it doesn't say that, well, because these guys can do this with all this equity, it doesn't mean that the banks could do what they do with all the equity, because they're not doing the two-product thing, they're doing the one-product thing of commercial industrial lending. So just, you got to be careful how you interpret the data as like equity isn't expensive or something like that, or equity is, as banks would be just as profitable if they were all equity and didn't have any deposits.
One thing that's come up slightly in different ways is the concept of narrow banking broadly. Just a little editorial comment. So Andrea and I were just in Argentina, which is a fascinating country to be in right now, and met with a bunch of bankers who are basically, all they do is fund the government. And they said, we need to learn how to make loans again. I would just say narrow banking in Argentina does not look like something we should be opining for, reaching for here in the United States of America. It didn't seem like an economy that was functioning very well in getting credit out to firms. You mentioned, Hyun, like, why do banks hate capital so much? Anybody want to offer a thought on that?
Well, I think this is what Doug actually closed his last remarks on. the cost of, I think it's very, very interesting just to ask the question, what is the cost of equity for banks? There may be these other reasons that Doug has mentioned, where the comparison with the private credit firms is not a good one. But certainly for the private credit firms themselves, the cost of equity is actually met by the interest rates that are actually paid by the borrowers. So, and so I think the question is, how large are these other institutional features that could raise the cost of equity beyond what the rates that are being charged by the private credit firms are? Is it like twice? Is it like 3 times? I think we should sort of try and measure that, because the other alternative hypothesis is that there may be other frictions within the banking sector that we have to look at as an explanation for why they're so averse to capital. And I think one hypothesis that has been out there is, if we look at the total revenue before costs, so we typically take income as revenue minus costs, but costs are also important when we look at the division, because costs, remuneration is very much part of that picture. So if we think about the division of the cake between remuneration and the part that goes to the shareholders, that cutting of the cake very much depends on various measures like return on equity, and it's the return on the book equity that really matters here. I think this could be one of the reasons, but there may be others.
Doug, did you want to add something?
Actually, related to what you said about Argentina, and related to Andrea's stuff, to the extent that the banks need some sort of collateral or something for creating liquid claims, there is the idea that it's like related to the convenience yield story, that in some sense equity clearly doesn't have the convenience yield, maybe even the long-term debt doesn't have the convenience yield. So do you want to have just government assets backing up as collateral for the liquidity stuff that's done by the banking sector? There is, I've thought a lot of times, I think there is a synergy between doing some private credit, not in the sense you're talking about, as a non-government credit,
right,
together with banking, and then in general equilibrium, you could have a fringe of people who weren't doing this, but you couldn't have the whole system doing that and get the same allocations. That's sort of that's a different way of thinking about why equity is so. It's not so much why equity is so expensive; it's why deposits are so cheap.
Right. Let me ask you one last question. I'm going to open it up to the floor. Doug, you mentioned mark to market. I got to say, I have scars in 2008. Like, in the middle of a crisis, mark to market is terrifying.
Yeah.
All right. And it's like, boy, in 2008, the last thing we wanted to do was mark every bank's balance sheets to market, because all of a sudden, not just the financial system as a whole would be insolvent, every bank in this moment would have been insolvent. And so I get what your arguments, but as a firefighter, it scares me.
So I was talking about ex-ante incentives for supervisors, right? So like, suppose the firefighters are also the people inspecting the sprinklers, right? So if they had to go,
in theory, we were.
So if you had to go in without any suit on to fight the fire, you'd work harder on working on the sprinklers.
Sure. Okay.
So that's the idea.
Okay. All right. Let's open it up. We could take the whole time just with us. Questions for folks? We got microphones coming. Chari.
So this is to everybody, but Doug in particular, because it's inspired by what he was talking about Silicon Valley Bank. And this is really a two-part kind of question. One is, in thinking about how we design an appropriate financial system, one should be very conscious about what the externalities are, what the coordination failures are, and I wanted some help in thinking that through. And to the extent that that one thinks that there are externalities or coordination failures, it seems to me, and Chris Feld and I have a piece on this, that the fundamental question about how to regulate certain financial institutions, particularly banks, has got to start from the question of what sort of assets do you want funded by what sort of liabilities? Any system where you have 30-year mortgages financed by overnight paper just seems nuts to me, particularly any system where government securities, long-term government securities, which could well be traded in public markets, be financed by overnight paper. Just seems like a crazy system. So I guess part of my provocative question is, why aren't regulators thinking more about what sort of assets in equilibrium ought to be financed by having, for example, short-term debt claims? The kind of assets that are very information sensitive, such as commercial industrial loans, I fully understand. Mortgages, mortgage-backed securities, I just don't understand. I don't understand why long-term debt is to be held by banks. So the most provocative way of saying this is, should we just prevent them, these institutions which are relying on government guarantees, from holding this kind of nonsense?
So one way to think about that is, if the people who wanted to fund the banks wanted to give short-term deposits, and let's say they couldn't necessarily, they didn't have enough short-term government debt out there to just do this as a sort of a effective government money market fund without all the subsidies and bailouts and things like that. The alternative would be, take the long-term stuff, and then if the market's more complete, swap out the interest rate risk. So once you don't have to mark the stuff to market, and once you have a lot of this funding in large uninsured deposits, then the fact that we don't have the mark-to-market in the capital requirements basically sets up something like we saw in Silicon Valley. So it's like giving, I think it's probably not the case that you'd expect to see Silicon Valley be very profitable in generating claims that were had prepayment risk equivalents to mortgages in them and things like that. So they want to issue simple claims against simple compared to commercial industrial loans, relatively complicated stuff like agency securities. If they want to do that, then they should be and the market works pretty well, they should be induced to swap out the interest rate risk. Right now they don't have that, but it's not so obvious given we know there is this other way to create short-term debt out of government securities called repos. It's not quite clear that the commercial banking system for big uninsured deposits is better than just repos. Repos have issues of their own, general equilibrium issues, but I'm with you on that. And then the question is what's true how important is the non-securities lending, the commercial industrial lending of the US banking system compared to what it was 50 years ago? I don't know good numbers that apart from just looking at market shares and things like that in portfolios, I don't know in terms of value added how we can really get at that, but that's the best I can say on that.
Other questions?
Yeah, I just had maybe a couple of points and then it'll lead to a question. So I wanted to take Andrea's sort of view that these large banks are like financial supermarkets, and there seem to be tremendous synergies, one would think, in keeping reserves and deposits and then pretty much providing any financial service that's out there. So that makes me a little bit of a skeptic of non-bank financial intermediation in the following sense, that most likely you have constrained the financial supermarket from being the financial supermarket, and that's what has caused all these sort of flowers to bloom on the side. And so my question is the following, which is that we seem a lot focused on the capital structure of private credit, which is that it has a lot of equity, looks more than that of banks. But I think from a financial stability or efficiency of intermediation standpoint, I think the question we have to ask is, at what point will their intermediation start getting affected? So if they are at 35% equity, but their intermediation will start getting retrenched at 35% equity, in a way, that's not high enough equity. And I think if you look at their capital structures, this is what you see. They have a lot of bank credit, firstly. They have covenants in this bank credit which tell them that your assets to debt have to be at least 150%. Their lines of credit will not be at cheaper costs if they violate that capital requirement. So it seems that effectively the whole thing has rotated, their capital structure has rotated around where bank financing will be cheap for them. And that's entirely based on capital rules. So I think I just wanted to pose a question, which is, should we be focused on private credit only from their capital structure or solvency standpoint? Or just like banks, should we ask the question, at what point will they stop intermediating to the real economy? I don't know the answer to that, but I just wanted to pose that question. And then a last sort of example on that, which might make it more tangible. So pension funds in UK are sort of all equity, but it just took them like a small derivatives position to run into a tremendous liquidity problem and sort of mess up the UK gilts market. Of course, there was a background shock and so on. But that's a good example of where having an all-equity capital structure doesn't always give you the strength to actually deal with an immediate liquidity shock, because equity is not where you go for liquidity. You know, you have to tap into a bank or some market finance.
But just to follow up and make sure I understand, my impression of private credit is not only the equity finance, it's also longer-term funding. So why would they feel the liquidity pressure that the pension plan was facing in that moment? Sorry, we took the microphone away from you. Can you take the microphone back to him? I'm not arguing. I'm just trying to understand, make sure I understand the point.
No, because they would. So the question is, what will stop them from intermediating? So suppose they grow to be a large part of some part of the economy, then they have to keep originating. You never originate by going back to your equity financiers. You always tap down a line of credit, and then you rebalance your capital structure in parallel. So you could run into a cost, your cost of market finance or your cost of equity finance increasing because VIX has gone up. The only way you can continue originating now is if you can draw down your credit line. So that would be like, so just a typical non-bank cyclicality that when VIX goes up, market finance will become expensive.
But don't banks also, when there's a shock that hits the economy, some downturn, I mean, banks also retrench. So I guess what I'm struggling with is, yes, you're right, private credit could retrench, but banks could retrench in that same economic environment. It's not, I mean, banks like to say that they never retrench, but they obviously do. I don't know, let me open it up to our experts.
Can I have a go, actually? I think, Viral, I think your point is a very important one. I think the way that I would pose it is certainly leverage is going to give you the ingredients for the pullback when conditions tighten. But as we saw also in the UK gilts episode for the pension funds, you can have leverage-like behavior even though you're not leveraged. And one way to think about this, I mean, that was the LDI fund, which was a special feature. But in general, if you're actually following some duration matching principle, and you're reacting to how the duration of assets and liabilities change with market rates, then you could get something like this actually synthetically. So let me give you an example. Typically, duration of liabilities of life insurance, typically, but also pensions, liability duration is longer than asset duration. So liability duration is much more sensitive. So it's the convexity. So when rates rise, the duration of both come in, but liability duration is coming in much faster. So what you find is that you've got too much duration on the asset side, because liability duration has come in much faster than asset duration. You've got too much duration on the asset side. So you could do that. So you could address that by selling. So what's just happened? Rates have risen, but you're selling assets. So that could also generate this feedback loop, because by selling, you're actually sending rates higher even. So that's one example where it's not just leverage formally that's going to cause problems. It's the leverage-like behavior of whatever other things are actually going on. And this is what I was trying to get at with the risk management story. So you can manage risk by mitigating your loss, but it's the question of what other externalities are being generated. And this is Chari's question. What else is happening when you're actually cutting your exposures?
Andrea, did you want to add?
Sure. I guess I'm going to come at this from my hedge fund days. So you talked about like the disappearance of the subprime securitization market. And the reason, one of the kind of ways that happened is those were held in hedge funds that applied leverage to them. But ultimately, and they did have a fair amount of leverage, but not as much as like, an agency kind of standard security. But ultimately, the problem was that in the depths of uncertainty, you could not, the ones that survived had the equity investors that stood around. They were in the top 10 hedge funds over $1 billion for years afterwards, because the ones whose equity investors did not infuse additional capital all failed. So I think you're right that, even if you think that they have a high amount of equity, they can still be subject to kind of a high cost of drawing additional equity whenever any leverage that they have puts them in an insolvency position. But what I think about this whole discussion, it kind of takes me to, I teach fintech, and I taught stable coins for the first time last year. And those are sort of like trying to be like narrow banks. But it's really interesting how they tried to kind of invest in somewhat riskier assets, and that really, caused them to sort of break the buck quite often. So they had to go sort of super narrow to achieve stability. But I think your experience in Argentina begs the question. It's true, if we make banks be narrow banks, they may not do so much lending. But I guess, how much can private credit take over or other institutions take over? It's true that right now they're doing, that the kind of credit that private credit is providing is not the same as where banks are lending. But we don't know the counterfactual of what things would look like in a world where we had banks providing liquidity services and other institutions providing credit. And I'm not even advocating for that. I'm just posing it as a question.
Fair. Doug, final thoughts?
One brief thing, the private credit firms, because they have these lines of credit and other contracts with the banks, already are sort of on a dynamic capital requirement, so mark to market. And we see those guys, we see even like the CLOs have something like that. They have the funding, which is locked in for longer terms, but they still have to recapitalize themselves and potentially be on Hyun's point, they could be forced to sell assets if they become undercapitalized. So in some sense, the private market deals with this in a way that the supervisory regulatory sector doesn't. So maybe one reason that they're able to compete is they just have a better contract. And the CLO stuff, they made it through the great financial crisis. They're looking pretty good right now. They're now trying to ETF those guys so they can get public money in there. that may make the whole thing blow up, who knows? It may change the incentives for the way you write these contracts. But I think just thinking about why the private credit stuff is doing better from just a contract incentives point of view, maybe another perspective.
All right. Well, we could keep going for a lot longer, but I know we have a full agenda today. So join me in thanking our wonderful panelists.